Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee. Joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewiton, and Executive Director of Global Content, Emily Parker. Good morning, Emily and Lawrence.
Good morning.
Good morning.
Let's have a live look at Bitcoin. The CoinDesk Bitcoin price XTX index is at $30,522. Bitcoin rising just over 2% over the past 24 hours. The CoinDesk Ether price ETX index is at $20.95, up about 3.3%. And the DFX CoinDesk DeFi index is at 151, popping up over 6% over the past 24 hours. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So it's interesting to see the markets pop up a bit, ending that 7-day losing streak for the past 7 weeks, Lawrence.
Yeah, well, it's going alongside the rest of the equities markets. We're becoming a world where Bitcoin is now a proxy for global growth rather than or speculation on the health of the global economy rather than a hedge against it. So that's where we are, and that's what we're seeing.
And taking a look at Twitter, Elon Musk has been tweeting out 20% of fake spam accounts, while 4 times what Twitter claims could be much higher. My offer was based on Twitter's SEC filings being accurate. Yesterday, Twitter's CEO publicly refused to show proof of less than 5%. This deal cannot move forward until he does. So, Emily, it seems Elon is getting cold feet on that $44 billion offer to buy Twitter.
Right. So this raises a few questions, the most important of which is, wouldn't he have thought about this maybe before? And I think there are some questions out there asking if this is the real reason why he's getting cold feet, or if he just lost money on tech stocks and possibly on crypto as well. Obviously, that's speculative, but the timing of this raises some questions.
Right.
Yeah, this definitely, this is going to be crushing for Twitter, I think. If the deal doesn't go through, because now you've raised the specter that even if it's not true, that potentially they're lying on their SEC documents. So Twitter now is dependent on, I think a lot of people there weren't thrilled with Elon Musk buying it, but now they're dependent on him buying it. Otherwise, their stock price tanks. So terrible world for them to be in.
Interesting game Elon is playing. Well, crypto is doing some soul searching right now. Many folks who believed they were supporting a project that would revolutionize the world are realizing serious flaws in that thinking. Others are in denial, holding on to what little they have left and hoping that they were right all along. Joining us now to discuss, we have a chart here of Terra Luna, obviously trading for less than a fraction of a penny right now. UST also far from its peg. Joining us now to discuss is a lot of zeros. Paul Brody, Ernst & Young, Principal and Global Innovation Leader and CoinDesk contributor. Paul, thanks for joining us. So, it's interesting because, when people become religious about crypto and the project clearly fails, why do people continue to cling on to the project? At what point do you sever trust and confidence and let go and move on?
Hi, I'm sorry. The network froze here, and I missed what you said. So if you just ask me again, I'll get to that. So I have a. This time I don't.
So we're saying that crypto. There's a lot of soul searching going on in crypto right now. And through a bull market, especially, people get so religious about crypto and the project that they're working on. But when that project clearly fails, why do people cling on to it, cling on to the leader of the project as well? At what point do you sever trust and confidence and move on?
I think that's a really tough question. What I look for, and the reason why we're very focused at EY on the Ethereum ecosystem, is I'm looking for institutional maturity. It's not just one person. It's not just a cool idea. It's the broader institution. And what I talk to a lot about EY clients, what I talk about my colleagues when they say, hey, look at this cool new thing. This seems really interesting. What I say is, okay, we should monitor those things. We should check them out. But the reality is that we have to be focused on the organizations that can be good stewards of this massive investment that we are making in an ecosystem. And if you look at the Ethereum Foundation, and the Ethereum organization, they are triumph of incredibly boring stuff. Standards committees, organizational maturity, slow, repeated tests of the merge before doing the merge, right? This is everything you want in a stable, mature institution. And that's why you should let those things go on. But I think I love the enthusiasm the blockchain ecosystem brings to these new organizations, but kind of betting your life on this stuff, it's not, and it's hard for me to tell you when you should give up. But I think you've got to look for a layer below and look at the people that are driving it, the institutional maturity, and the mission-driven nature of Ethereum to some of the others, which feel much more like, hey, I have a cool idea. I think it's worth some money. Let's go monetize it.
Well, Paul, just referring to the whole Terra Luna collapse, Do Kwon, who's the CEO of Terraform Labs that created Terra Luna, he's suggested a recovery plan. Now he wants to fork the project and raise money to boot. And this is barely like days. Like the billions of dollars have been barely like accounted for at all. And there's already talk of, moving on, let's raise some more money.
Hope springs eternal. That's all I can really say. I mean, I'm a part of an accounting firm and a professional services firm. So I would tell everybody else what I tell my friends and colleagues, which is you've got to do your homework. And doing your homework means looking for things like, do they have an auditor, right? Who's verifying the source of these funds? Has anybody examined this stuff? And I wouldn't park my money in a company that didn't have an auditor. I invest tokens in a system that hadn't been audited, and I wouldn't do anything else without some verification. And it's not that there's any one particular auditor or third party that is better or worse than the others. The principle that matters is it has an independent third party who is committed to responsibly evaluating the solution, actually evaluated. It's this principle of independence that matters so much when trying to get your hands around what is and is not a good investment of your time, your money. And honestly, something like in blockchain, it's an emotional investment as well. I'd be lying if I said I was not emotionally invested in this grand project that we're on.
Paul, that's great, but we have to remember this is that the majority, and not just the retail public, although certainly that is the case, but also the institutional market. Crypto is not exactly at the forefront of their radar. The blockchain is not at the forefront of their radar. They're kind of like passing interest in it still. After 12 years or so of this, that's what's happening. They see these spectacular blowups. They don't know the difference between, quite frankly, UST and USDT and USDC. As far as they're concerned, a crypto blew up and people lost billions. Whether or not it was blockchain related or not, they look at that, they just see the headline and go, nah, not for me. Does this kind of a catastrophe, and it is a catastrophe for many people who lost their life savings, does this kind of catastrophe set back adoption of blockchain technologies, adoption of cryptocurrencies in ways that, despite all the advances that are made in the technology, they can't overcome?
Not one bit. So very simply, I could do a global search and replace. I could tell you about pets.com, Cosmo.com, Webvan, right? So many companies in the early phases of the dot-com boom went bust. And people I worked with, and I was a McKinsey consultant at the time, I heard clients say things like, see, I told you people will never buy their groceries online. That just wasn't true. Today at EY, we are launching more blockchain products than we've ever done before. We are launching products that are for supply chain management, for assurance and accounting, for security testing. I believe just like the internet, just like e-commerce, there's going to be all these ups and downs. It's not going to slow down adoption one little bit, because the people who do know, the people who do understand are not deterred in any way. And so I think the amount of time it takes for the skeptics to get on board is going to be quite long. It always is, right? We have clients at EY today who are still evaluating a transition to the cloud. That is how these ecosystems work. You've got your early adopters, you've got your mainstream adopters, you have your late adopters. Those people are skeptics. They're going to wait for everyone else to go first. So I'm not distressed. I'm not deterred. I got 300 people downstairs that are waiting to talk about the future of blockchain and Ethereum, and they're not deterred either.
So, Paul, you're coming from a slightly different perspective from EY, but, a lot of the words that you're using, third parties, institutions, I understand the logic behind them, but in terms of the whole point of cryptocurrency, it's some people would argue that actually that's kind of not the point of cryptocurrency. So I guess, but the main question is in terms of soul searching, putting aside some of the EY cases, where are the actual use cases of decentralized technology? I mean, we hear a lot of theoretical use cases, we hear a lot of niche use cases, but I think when Christine refers to soul searching, we're 13 years in, and there's just not a lot of use cases that people can talk about, and I'm talking about real use cases, not 10 people paying with Bitcoin because it's cool, right? I mean, could you just give us some concrete use cases that are somewhat mainstream and somewhat large scale? Because I think those are the responses that this industry needs to people who are like, what is the point of all this?
So you're exactly nailed it on. We have a phrase here that we talk about, which is that we believe blockchains will do for networks of enterprises what ERP did in the single enterprise. And here's what I mean by that. ERP, companies installed these systems and they got the left hand and the right hand kind of connected up, and it drove gargantuan efficiencies, but it only worked inside the enterprise, inside the four walls of your enterprise. One CEO could say, hey, we're all going to use SAP. Everyone's going to have the same numbers and the same process, and we're going to be very disciplined. When it comes to transacting with other companies, that's not possible, right? You can't make everybody else use your system. It doesn't work that way. And so the miracle that blockchain offers is the ability of complex business processes like supply chain management. Think about all the stops that your products make from manufacturing to the retail store. They're controlled by many different companies, right? Same thing for your phones or any of your electronics products, right? There's chips from one country, assembly another, distribution a third country, right? These are multi-stop, multi-company ecosystems. And the only way that they work together is by having a truly decentralized, independent system that can allow companies to transact with each other. What's holding all of this back, and the reason why I'm so passionate about this, what's holding all of this back isn't the fundamental vision or the value proposition, it's privacy. Nothing in standard blockchains is private. For all the stuff that this is built upon, and it's all built on cryptography, the material that we're moving back and forth, the data is not private. You know who did what, and if you have a smart contract and you can read it, you could see who was paying what for what. And that is anathema to large enterprises. And this is why, for the last 6 years, we have been prioritizing. Can I just finish this one thing?
I just know you have to go in a minute. I want to ask you
fixing privacy. Okay, yeah. Fixing privacy is the critical thing that we are trying to do because that's what unlocks all of this value. Sorry.
Sorry to interrupt you. I know you just have. I know you have a hard stop, so I just wanted to quickly ask you before you have to leave about this supply chain China project that you're working on.
So it's not a China-specific project. It's a supply chain project. We are just releasing for the first time our first product called Supply Chain Manager that allows you to do secure business transactions, to track inventory, and to do it on a public blockchain. And the reason this is possible is because we are going to start using Polygon Nightfall. And Polygon Nightfall is a layer 2 privacy-focused rollup that allows you to have secure transactions that are fully private from your competition. And this is what we've been working on for 5 years. Today is a culmination of 5 years of work to make it possible for enterprises to use public blockchains for real business problems without compromising their secure, sensitive business information. That's the big achievement. That's why I'm so pumped, because I think we're really just getting ramped on the really big use cases.
Awesome. Well, congratulations on this launch, Paul, and hope it helps in building confidence in the blockchain and crypto world among mainstream audiences. Thanks for joining us. That was Ernst & Young Principal and Global Innovation Leader Paul Brody. Coming up, we've got a crypto markets update with Brazilian asset manager BTG Pactual. Live look at Bitcoin. The CoinDesk Bitcoin price XVX index currently at $30,494. Bitcoin is up about 1.6%. The CoinDesk Ether index, ETX, is right now at 2093, also climbing about 2.8%. The DFX CoinDesk DeFi index is at 151, soaring about 6.2% over the past 24 hours. The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Crypto markets taking their cue from the equities markets. And here to discuss more is Andre Portillo. He's head of digital assets at Brazilian asset manager BTG Pactual. Good morning, Andre.
Good morning, guys. How are you doing?
Good to hear from you. Good to see you. Of course, we're seeing Bitcoin and other crypto up today, and it's in light of some positive movements in the equities markets, particularly in Asia. Are we seeing Bitcoin specifically act more, as I said earlier in the show, as a proxy for the global health, for global economic health, when it used to be a hedge against potential downturns in the global economy? Has it changed its role?
Yeah, I think we've definitely seen exactly like this. Okay, especially this year, all the markets, crypto and traditional markets are moving, with a much higher correlation than we used to see, and I think that's everything related to what we're seeing in inflation and Fed. So now it's affecting all let's say the asset class, right? And I do think not only if you take the case of Bitcoin, but all other crypto that can maybe connect more with technology are behaving on the same way, right? On the other hand, specifically on Bitcoin, the market looks like it's struggling a little bit to maintain its price below 30K. Okay, I think last year we touched a little bit low, but the market's correcting very fast to the upside after market stabilized. Okay, so I think there's two things that I'm watching, and the big question is like the higher interest rates that we are seeing right now. That's the big theme of the market right now. Okay, when the Fed needs to move, it will affect all asset classes in a sense, but it should affect much more, let's say, a cash flow generating asset classes. So if you take everything related to equity, bonds, real estate, that should be affected by a higher interest rates environment. If you look to blockchain and Bitcoin, they're not really affected by cash flows. They don't generate cash flows. So the question is, will this correlation break sometime in the future? I think that's the question that I'm trying to answer, and that's the point that the thing that I'm watching most here. Will the market somehow down the road start asking this question? And okay, depending on what happens with the dollar and with the traditional markets, can Bitcoin, actually become, like I say, a more safer haven that like it's behaving? I think that's the question that I'm looking for, right?
So, potentially one reason we're seeing this, of course, is that as institutions adopt crypto and Bitcoin specifically, that they will change and they'll allocate their portfolio according to situations happening in the overall market, and that if they're speculating in the technology of Bitcoin, it's acting as if it's a tech stock. At least that's been some of the argument. But stepping back now, we have this in mind. What are we seeing? What are you seeing? You mentioned this sort of bounce off from these 29,000s or so. You expect it to go higher, correct? And if so, who's doing the buying? Is it institutional in this case, again, as they allocated according to their portfolio, or is it more retail? What's your sense of what's happening right now?
I think on these current moves, it's too early to tell. Okay, this 30K point that I made is just something that, well, the market's telling me that, okay, unless there's something more strong, more strong in terms of the Fed and the markets, the market's struggling to be below 30K, okay? On the other hand, if you look to specifically more about Bitcoin, You have all the demand, right? Like you mentioned, institutional adoption, retail, and of course, when you have institutional adoption and the asset class goes mainstream, which say it's not more like just a niche asset where just crypto people uses, it sorts well. It makes sense to be more correlated with other asset class, right? But if you take that 30K, one thing that we need to observe is that, well, we have all the, let's say, the demand side, which means new adoption, new people coming into the markets. If you look to, well, the non-zero balances addresses in Bitcoin Ether, it goes steadily up, okay, every week. But on the other hand, you have the supply side of it as well. Okay, and what we see in Bitcoin is that, well, supply is getting smaller and smaller. So although last week we have we've seen a lot of new coins coming back to exchanges, right? If you look, let's say, since the March 2020 when the lockdown started, it's a steady move down of coins getting out of the exchange. So what that tells me is that, well, there are new people coming into the market and people who are maybe buying this to hold for a longer period of time. Okay, again, this is data. We need to just watch the data as the market moves. But that's what I'm trying to take from the data right now. Okay, my sense right now is that we still have a lot of things to understand on the Fed behavior. Okay, I think the Fed, we might be in a situation that the Fed will need to be more aggressive than it is today, right? With the inflation that we are foreseeing right now, and the Fed talking about neutrality. I think there's some higher risk that they need to be more strong in their acting, and that for sure will continue to affect crypto. But until we have this thing more clearly, we're seeing that we might have, more calmer markets, at least in the next few weeks. Okay.
I just wanted to turn the focus to Latin America, which I believe is a region that you know well, and we don't always hear a lot about it in the US, but it's a really, really important player in the cryptocurrency market. I mean, we have some really major markets like Brazil and Argentina. And so I'm just curious if there's anything notable that's happening in the region in terms of the response to this market crash, or is it just kind of like a similar narrative to here in the US? Because it seems like there are some different use cases in Latin America.
Yeah, what I think that's a very interesting point, because if you take Latin America and you look at crypto, and as it is a very, let's say, flexible technology, we're seeing very different use cases when you look to different countries in Latin America. Okay, so for instance, you look to Mexico, people use a lot for remittance. I mean, a lot of Mexican people live in the US sending money to Mexico using crypto in a much more efficient and cheaper way that you'll be using the traditional rails, right? But if you go, let's say, to Argentina or Venezuela, people uses Bitcoin much more to escape the, let's say, the sovereign currency that, well, in process of hyperinflations and a lack of confidence. If you watch in Brazil, it's much more similar to the US when people use for, let's say, investments and speculation. So I think it's a very interesting point how people use this in a different way. I've been talking to a lot of clients here at BTG, not only retail clients, but also institutional clients in the last, I would say, 1 year. Okay. And the demand for having crypto conversations increased a lot since, let's say, last half of last year. And the interesting thing is that, well, after we have this correction this year and now way more, the conversations that I'm having, they didn't went down, on the opposite. So people are demanding, okay, I don't have any exposure to crypto. Now that market fell like more than 50%, is the right time to have some exposure? Or the people have a deeper understanding, wanting to discuss the thesis. Okay, what do you think about gaming? What do you think about DeFi? How long do you think this thing will go to the market? So it's a very different behavior if you look, let's say, to 1-2 years ago. And I think that tells me something about like institutional adoption, like the technology going mainstream. I think that's the case that we need to be paying attention right now.
Well, it's interesting you say that because as we speak, there are 44 countries that are meeting in El Salvador right now to discuss Bitcoin cryptocurrencies. And they're all from emerging markets, developing countries, central banks, and notably the United States and much of the West is exempt from this meeting. So, I just wonder, what are your thoughts on the significance of this? And, is crypto good for countries that despite its volatility?
I see this in a very pragmatic way because I think this is a process, okay? And if you take, for instance, US or even Brazil have a very sophisticated financial industry. And for instance, in Brazil, we don't need crypto or Bitcoin for payments. We have a very sophisticated instantaneous payment system in Brazil, okay? Probably have the same in the US. So for us, that's not a use case. But if we look more broadly, there are several countries that they don't have this kind of infrastructure. So the question is, can crypto be the technology, the infrastructure to increase the pace of these countries being able to have a functioning payment system? My answer for this right now, it's yes. Maybe the technology is not there yet, but I think this approach, okay? So the technology will be capable of solving most of these problems probably in the future. If we take a look back in other technologies, a lot of things that are happening in crypto right now, they're not exclusive to crypto. They happen in several other different technologies in the past. It happened to the car, it happened to even the internet, okay? So I think it's definitely worth the discussion. And we, that live in countries that have a functioning financial system, we should not look just to our use cases. We should look more broadly and understand, well, not every country has the same capabilities that we have, right?
Mm-hmm. It's interesting you say that because, El Salvador is pushing this meeting, but so far their Bitcoin experiment has had a lot of setbacks, but they're trudging along. All right, Andre, thank you so much for joining us. That was BTG Pactual Head of Digital Assets, Andre Portillo. Coming up, how is the fall of Terra Luna and UST grabbing the attention of regulators? And checking in with CoinDesk Global Policy and Regulation Managing Editor, Nick Day.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
As the crypto industry is still reeling from the fallout of the whole UST debacle, the next question is, how will regulators react? Most specifically, will we see regulation for algorithmic stablecoins? Joining us to discuss is Ron Hammond, Director of Government Relations at the Blockchain Association. Welcome, Ron.
Thanks for having me. Really appreciate it.
Perfect time to have you here. I'm really curious to hear how you explain this. So let's just start out with just the big picture. I saw some of your tweets from, I think, yesterday. Tell us about what is the reaction in DC? Because what's interesting about this UST implosion is that the crypto community is kind of obsessed with it, but a lot of people, I think, just don't even know what it is, right? So you mentioned that there is a reaction in DC. You compared it to Libra. Are regulators or lawmakers, do they understand what's going on? Do they understand what happened? And are they freaked out by it?
Definitely. I think you can easily say that there is a pretty adverse reaction right now here in DC to the whole Terra situation. And there was definitely a lot of folks who were monitoring it, both in Congress and on the regulatory side. And even before the crash, there was some interest in algorithmic stablecoins for quite some time. However, I will say it was mostly largely focused on the single fiat-backed currency. So the USDCs, Tether in particular. Tether got a lot of attention here in DC. I did a few meetings with the Terra folks, as well as, I know the DAI folks have been on the Hill and a few other folks in the algorithmic space. But I will say that for the large part, Congress decided that we should take this one bite-sized chunk at a time. And so for the longest time, it was Libra that dominated the headlines. And then they moved over to USDC and Tether. And now algos have taken up a lot of the conversations. But candidly, most folks on Capitol Hill, they know algos are different from USDC, but they really don't know exactly that there's multiple types of algorithmic stablecoins out there. And they don't know the difference between like DAI, for example, and UST. So that's a lot on us on the lobbying side. We got to make sure we just at least educate the policymakers to understand that there is a difference between these folks. One thing I will highlight, though, in particular, is that Secretary Yellen of the Treasury testified in front of Congress in both the House and the Senate last week. And this is all during the crash. And so this is a lot of folks who are asking questions on this matter. A lot of it is really organic questions. These weren't planned questions or coming from different groups or organizations. These were just legitimate curiosity. What are you doing in this space when it comes to regulating stablecoins? And Secretary Yellen said multiple times, we came up with recommendations in the presidential working group. That's the Biden administration's plans to regulate stablecoins. But it's up to Congress, though, to pass those rules. And they don't have to exactly be what the Biden administration recommended. However, it needs to come from Congress. And Congress does act pretty slow. So there's a lot of pressure right now on Capitol Hill to act. But also there's a lot of pressure from folks on Capitol Hill to the regulators saying, we need you guys to prevent something like this from happening. And so it's kind of a catch-22 here. So do we go after actively the bad guys here, or those who are not being so truthful to investors? Or do we put together a framework here and at least understand what can and can't work in the United States? And I think that's more what Congress will be going towards, but there's a lot of politics in play, and that's been really complicating a lot of stuff. But I will say that stablecoins did dominate a lot of our conversations all of 2022, and it looks like it'll be continuing that for quite some time.
So, Ron, I'm really happy you're here because I really hope you can answer this question that I have not been able to get an answer to. So we have seen a lot of talk about regulating stablecoins over the past year. There's been various reports, but regulating algorithmic stablecoins specifically, could you just go through what even the menu of options are? How do you regulate algorithmic stablecoins? Because as you just said, they are somewhat different animals. So when people say, okay, we're going to start regulating this, what does that even mean? What are some of the options for regulating algorithmic stablecoins that you've heard tossed around?
Well, actually, that's the funny part about it, is that there have not been many conversations on regulating algorithmic stablecoins. For the longest time, even in the Biden administration's plan, in the presidential working group, they barely touched algorithmic stablecoins. They said, there's this thing here, algos, we know they're more complicated. We'll get to that down the road. And a long time in Congress, too, we were having the same conversation saying, look, let's go after the biggest large market players here, the Tethers, the USDCs, just making sure we have a regulatory framework here. I will say Tether is very unpopular on Capitol Hill between both Republicans and Democrats. But USDC has been seen as a really good innovation, for example. And that's not just them, but that's one big, large example. It's been here on Capitol Hill and testified several times. But algos are really outside the purview. And again, most folks did not really deal with it, besides a few staffers and members of Congress until last week. I can say right now that there is a briefing that's going to be happening on the Democrat side of the aisle on what happened, what is it? And it's not with Terra, it's with a lot of folks in the stablecoin realm and those who are for stablecoins or CBDCs, and then those who are not for either. So this is the kind of perspective that Capitol Hill wants to learn more about. And I think that's a really important thing to highlight, is that Congress does take a long time to get policy passed, but they're taking a really hard look at making sure that they understand the issue fully before diving headfirst into it, which is good. And I think that should be really welcomed. We don't want to be regulating off emotions here or, what happened last week. We want to make sure we have a comprehensive framework, and it's bipartisan. And I can say for sure that, I'm talking to a lot of offices on both sides of the aisle, and there has been some really positive steps here. I think we'll see some bills introduced pretty soon. But candidly, though, I'm not sure many are going to touch algorithmic stablecoins at the moment, because a lot of folks are still scrambling saying, how do you regulate this? How do you regulate an algorithm? This is really complicated. We really haven't thought about this. Do we need to pause and address this down the road? They really don't know, candidly. So this is a tough position right now for Congress. And the less and less Congress acts, it gives more leeway to the regulators, which are a lot harder, more to control, but also to map out exactly what they're going to do. So we really hope that the states Congress is clear.
So how would you do it? I mean, you're talking to people on the Hill, you're having conversations. I'm going to make a broad assumption here that your idea is that less regulation better and fewer laws better. Nonetheless, it's still something Congress wants to do, and they see something, they want to regulate it or tax it or destroy it or ban it or whatever it is. That's just what that's what they like. That's their job. I mean, that's what they think their job is. But what is it that when you sit down with them, what is it you're telling them to do? Hey, don't touch the algos at all. It's fine. Everything's good. Or is it like, yeah, this is a real problem because it's messing up everything for everyone, or in between? What exactly are you saying here? to them?
Well, first I would say, we actually are advocating for regulation and for legislation. There's some folks saying that, the entire lobbyist job is to prevent laws from happening, but actually I'd say it's the opposite. We actually want regulatory clarity. We want to have a framework in place. So these businesses that we represent, the Blockchain Association represents 90 plus companies now, and they want regulatory certainty. So at least they know the bounds in which they can operate their business. And that's really important because if they don't know, if it changes from one administration to the other, or the Congress flips and the other party is not so friendly, that creates an environment of uncertainty, and they're just going to go to other countries that have a lot more regulatory certainty in place. And a lot of that comes from legislation passed into law. And so it's really rare for, lobbyists to be advocating for regulation, but that's what we do. And most of that comes from education and explaining what this realm is, because it's so complicated. And in the realm of financial services, so go ahead.
How do you want the algos regulated?
It's still tough. I think right now we need to have some regulatory oversight. There probably should be definitely some audits and looking at the reserves here. That's been a huge focus in Congress right now, is focus on audits and reserves. A lot of that was tied to Tether. But I think now having a full-on audit of the algorithm, for example, will be something that a lot of folks on the Hill on both sides of the aisle will be open to. I will say the backing right now in Congress on both sides of the aisle, a lot of folks are saying it needs to be fiat currencies or cash and cash equivalents. They don't like the idea of the Libra model of having a multi-currency basket. They're not too comfortable with having cryptocurrency as a reserve as well. So that these are two areas right now that I think there might be some differences where some more pro-crypto members might deviate a tad. But for the general most part, fiat currency and cash equivalents are what they want for reserves, and they want regular quarterly or monthly audits, whether that be the actual reserves or whether actually the algorithm itself. So that's one area that they're looking at. But again, it's still very, very far away from coming up to a concrete idea. Again, for the longest time, we were focused on that single fiat-backed currency, and that was a huge focus for Capitol Hill for quite some time. And then the Russia-Ukraine situation happened, and I would have said 3 months ago, we would have some stablecoin legislation make its way through Congress in some shape or form. Ukraine happened, that kind of cratered it. Now I've put it back at 20%, 10% chance of something happening in this space. But again, algos are so complicated, and Congress has a very short amount of time before the election. It's going to be really hard to get this across the finish line.
Sounds like you're blaming Putin.
Maybe it just...
No, I mean,
you sound like President Biden you're blaming him for inflation and this too.
Well, Congress tends to be really focused on what's the hot topic at the time, so it happens.
Well, one question here, though. I mean, some of what you're talking about, these possible fixes, might actually negate the whole concept of an algorithmic stable period. So I guess just throwing out a question here, is there any possibility that algorithmic stablecoins would actually be banned just because it's like too much trouble to figure them out?
That has been a knee-jerk reaction in this space for quite some time, saying like, and this has gone all the way back to 2012. I don't get it, let's ban it. But we kind of got over that stage, I'd say probably in 2016, 2017. When I was on the Hill, I noticed there was a certain point that like we've crossed the Rubicon, this is here to stay. Algorithmic stablecoins have not reached that point yet. Stablecoins generally have, I believe, but not algos right now. And I think a lot of folks are still kind of wondering what's going on, how are we going to be able to have these exist in this current ecosystem and be able to regulate them properly, because we've seen that they're very harmful and they get depegged several times, unfortunately. So we're not there yet. I think we have to still give that use case of why do you need an algorithmic stablecoin? Who uses it? Why is it important? Telling Congress that traders use it is not really an appealing topic. But if you say, hey, retail investors use it, or there are underserved populations that use it, and here's why. And again, those use cases may or may not be built out for some of these algos. But right now, Congress is still scratching their head saying, why do we need this? But I will say, to the credit of other stablecoin issuers out there and those who are involved in stablecoin policy, they're not calling for bans either. They're not lobbying like the banks are, saying, hey, only banks can issue stablecoins, or we must ban all these things. They're doing a good job being very inclusive of the space and saying, we should embrace competition. We should embrace having multiple projects out here on the stablecoin front that look different from each other. But of course, you need to have those guardrails in place. And I think that still has yet to be determined how algos still fit in that mold. But I wouldn't say a ban right now, but you'll see some rhetoric coming out pretty soon, probably on that from some members on the Democrat side. But it's the Elizabeth Warrens, the Brad Shermans, folks that we're very familiar with, at least on the crypto side of things.
Ron, finally, I just want to pivot to another subject that has Congress's attention, and that's FTX. And Sam Bankman-Fried, the CEO there, his proposal to basically disrupt the whole trading, derivatives trading world, with especially with the CFTC, in that they want to directly clear margin-backed swaps trades. And I wonder, how do you see that proceeding, the reaction, and could it, how do you see things going?
Yeah, so I will give credit to FTX, and they're not a member of the Blockchain Association, by the way, but I will give credit to FTX and SBF in particular. They have made themselves available, especially SBF, to Capitol Hill very frequently. I mean, he is here all the time. If you look the other way, you can see the Capitol from my apartment, but he is here all the time, meeting with policymakers, staff, being as available as possible. And I think that really shows why FTX has been able to really build up a huge presence here in DC and get a hearing on this proposal of theirs. Now, mind you, that came at the request of their opponents, and Representative Scott, who chairs that committee, who had that hearing, represents ICE in his district. So he's very much keen to their concerns and their needs. But the fact that SBF and FTX have been able to really push their brand, as also push a policy proposal this far in Congress, is pretty remarkable. Will they be successful? Has yet to be seen, because the CFTC and the Ag Committee, which oversees it, they're still very much learning about this issue, whereas other committees like Financial Services, which oversees the SEC, for example, they're way more in the weeds on this. They have been for years. And we're seeing a push from a lot of the members on that committee saying, look, we understand this issue way more. This belongs in our jurisdiction. So it's kind of like a high school, candidly, where there's a lot of turf wars here. People want a certain piece of the pie. We've seen that play on the regulatory side with the SEC and CFTC with Gensler and Benham. I think this is going to be a trend that continues for quite some time. But at least at the proposal, we will see that gets a lot of accomplishment here. I think a lot of lies in the regulatory side because, like I said, Congress is going to be pretty much in campaign mode, pretty much starting at the end of the month. And that's when everything turns to hyperbole, rhetoric, and a lot of legislation and ideas kind of get tossed out the window until next year. And again, it's just generally what happens, but that's what happens during a election cycle.
Fascinating. Well, Ron, thank you for this comprehensive update on what's going on the halls of Capitol Hill. Appreciate you coming on. That was Blockchain Association Director of Government Relations, Ron Hammond. All right, let's check in with CoinDesk Global Policy and Regulation Managing Editor Nick Day, who is also the editor of CoinDesk's The State of Crypto newsletter. Good morning, Nick. So the U.S. government is warning crypto exchanges to watch out who they're hiring because they might get catfished.
Yeah, this is a warning yesterday by the U.S. government came out saying, basically, there are possibly North Korean government employees who are going to seek jobs in different IT roles, including crypto exchanges. And they basically warned to keep an eye out, lest they run the risk of their systems being compromised by, the North Korean government. And, we've seen this before. Companies get hacked and exchanges get, lose their funds. So valid warning.
If they're competent, though, I mean, maybe it'll prevent some of the downtime we've seen on some of these exchanges during hot markets. So anyway, we got a letter, you and I, and yesterday, didn't we?
Yeah, so we finally got a initial ruling from a judge in the New York State Supreme Court. Basically, for those of you who are relatively new to the show or new to CoinDesk, last year, we filed a Freedom of Information Law request with the New York Attorney General's office asking for documents that detail Tether's backing. This is the documents were part of the New York AG's inquiry into Tether and into its backing over the course of a couple of years. And we filed for the documents. Tether has objected, and we've now been kind of just going in a back and forth procedural mostly, where Tether lays out his arguments why CoinDesk should not have access to these documents, and CoinDesk lays out its argument for why the public will be served by being able to see what's in this backing. Yesterday, a New York State Supreme Court justice ruled that CoinDesk can actually, it's really just a procedural step. We can file an additional reply in the case saying, here are these arguments that Tether made, and here is why we believe these arguments do not, hold water.
All right. So I'm just curious, what happens from here?
Well, so this really was just a procedural step. What happens next is CoinDesk files its additional reply. It's called a SIR reply. We file that in the next couple of days, and then we're back to waiting for the justice to decide, what the next steps are. So whether that is an immediate ruling, whether that is, perhaps the justice will want to hold a hearing. hard to say at this point. But, once the justice comes back with that, we'll have a better sense of what things look like.
All right. Seeking Light in Darkness. Thank you, Nick, for joining us. That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com. Let's check in with Crypto Twitter for our tweet of the day. This is from Dan Tapiro, CEO of 10T Holdings, tweeting, the first truly global macro investment of all time, with El Salvador leading, 32 central banks, 44 countries flying to El Salvador, emerging countries leading adoption, first time U.S. not ahead in financial and technological innovation. This is a photo from the meeting happening in El Salvador with all those 44 countries and representatives learning about Bitcoin.
I thought gold was the first global financial instrument, but what do I know?
Well, digital gold. It's a new world, Lawrence.
Yeah.
Thank you, Lawrence. Thank you, Emily, for joining me. I'm your host, Christine Lee. Meantime, check out the hash at noon Eastern and all about Bitcoin at 3 o'clock. You're watching CoinDesk TV. Next up, stay tuned for the daily forecast to see what's happening in the Asia crypto markets.
The Terra saga rumbles on. Welcome to the daily forecast, May 17th, 2022. I'm Megha Chadha of Forecast, covering all things blockchain. Do Kwon's latest proposal for the Terra blockchain involves a hard fork and ditching the stablecoin UST. But will the community go for it? Meanwhile, in an exclusive interview, Singapore's sovereign wealth fund Temasek told Forecast that contrary to reports from last year, it doesn't own Bitcoin, but it is getting ready for tokenized assets. We'll take a look at that plus a whole lot more coming up. Let's get you up to speed from Asia to the world.
Join thousands of NFT traders who already start their day on CryptoSlam.
Let's kick off with more on the fallout from the UST and LUNA crash. In South Korea, the fiasco is weighing heavily on play-to-earn projects and their tokens. Local gaming giant Comtus saw the price of its play-to-earn cryptocurrency C2X plunge from around $2 to 82 cents by Tuesday morning in Asia, following the depegging of USD. The blockchain gaming project is on the Terra mainnet, and C2X says it has now decided to switch to an alternative which has yet to be revealed. Meanwhile, the South Korean financial services firm NH Investment and Securities has lowered its target price for Comtus holdings from around $137 to around $98. It said that the Terra Luna debacle has cast uncertainties over the play-to-earn business. South Korean gaming developer Netmarble's MBX coin, which has no affiliation to USD or Terra, had fallen from over $50 on May 6th to less than $9 by Tuesday morning. Fellow developer WeMade's WeMix play-to-earn currency has also experienced heavy price fluctuations, though that turbulence was apparent before Terra's troubles began. Share prices for all three companies have fallen over the past 7 days, with Comtus down 10%, WeMade down 4%, and Netmarble down over 17% Tuesday morning in Asia. Meanwhile, Terraform Labs co-founder and CEO Do Kwon has come up with a new plan for a path forward for Terra. In a series of tweets early morning Tuesday Asia time, Kwon confirmed proposing a hard fork of the Terra blockchain in his Terra Ecosystem Revival 2, which will abandon the algorithmic stablecoin UST. Under the proposal, the network will be forked, with the original chain being called Terra Classic, with the Luna Classic token, and the new one taking the name Terra and its native token Luna. Kwon's proposal is reminiscent of the 2016 Genesis DAO exploit, which led to the birth of the current Ethereum chain. He said that they believe this token distribution is the best solution for the varying interests and time preferences of each stakeholder group. He also said it creates the most viable path to revive the Terra ecosystem. But some UST holders clapped back at the proposal, saying that they lost their funds in the crash and urging Terraform Labs to address the issue. The hard fork will go live for community voting tomorrow, May 18th, Asia time. You can find those stories and a whole lot more at Forecast.news. LUNA, the cryptocurrency powering the stablecoin Terra USD or USD, was trading at over $80 just 10 days ago, and it's now been reduced to a fraction of a penny. So what's really happened here and what lies ahead for LUNA and USD? Benjamin Stanley, Business Development and Sales Director at Matrixport, joins in to talk about just that. It's great to have you again with us, Benjamin.
Thank you for having me.
Let's start with the basics on Terra USD and the LUNA. The USD, it's an algorithmic stablecoin. What exactly does that mean? How does it work? How is it different from other stablecoins like Circle and Tether?
Well, let's talk first about the collateralized stablecoins because they're a bit easier to understand. The two most popular you mentioned are USDC and USDT, and together they have a market cap of around 130 billion. So there's clearly demand for those. The way it works is very simple. The issuing entity says we've got liquid assets worth the equivalent of $1 on balance sheet for every stablecoin that we issue, and you can come to us at any time and exchange your coin for $1 in fiat. Now there's a decentralized version of this as well, and they're using crypto assets, but in essence the logic is the same. Every coin is backed by assets on the balance sheet. Now the other version is the algo stablecoins, and they're a bit different. They're backed by the promise to be able to exchange one stablecoin for the dollar equivalent value of another crypto. And in the case of UST, that was LUNA.
Well, USD is theoretically supposed to be worth $1 each. So how did it lose that dollar peg? And where does LUNA fit into this? And what's led to LUNA's value collapsing?
Basically, you're always allowed to exchange UST for the dollar equivalent value of one LUNA. And there's the catch, because that creates a twofold problem. First, the LUNA that you receive when you exchange UST is being minted out of thin air, and it thereby increases inflation, and so the value of every other LUNA goes down a bit, just because the network didn't get more valuable by just increasing the supply of LUNA. Then, of course, you want a dollar, so you didn't want a LUNA in the first place. So you're going out to the open market most likely and selling that dollar equivalent of LUNA for fiat. Now, that mechanism works both ways. So on the way up, people have to buy LUNA to mint UST, and that's pushing the price higher. Whereas on the way down, the inverse happens. The second problem is, however, a bigger one, because there's a bottleneck for these swap transitions that happen on chain. And this is where the peg broke. Something caused stress to the system. Then people saw that they couldn't convert the UST into LUNA fast enough, and so they went to centralized exchanges to sell their UST. The price for UST started to drop, which caused even more stress. Then panic happened, and then that created that death spiral.
The LUNA Foundation, the organization that supposedly supports LUNA, said that they would step in with Bitcoin reserves. Yet we've seen that USD dollar peg crumbling.
Yes, that's right. So obviously what's happening and that risk of a death spiral was very well known to the LUNA Foundation guard. They were aware of this. And so what they've tried to build a Bitcoin reserve in order to prevent that death spiral. The logic was that either you can convert the UST into the dollar equivalent of Bitcoin, or they would use the treasury to defend the peg off chain. Now that Bitcoin conversion wasn't ready yet, but even if, what we witnessed was that the pressure was just too large, and once panic broke. At the peak, we had about 2 billion of UST outstanding, and that was backed by just less than 2 billion of BTC.
And there have also been allegations that Citadel, BlackRock, and Gemini are behind the UST collapse. Your thoughts?
I personally doubt any of the aforementioned TradFi players was involved. I think Gemini even came out openly and denied any allegations. But that doesn't mean that there was no centralized actor behind it. They withdrew liquidity from the 3 pool on a decentralized liquidity pool that made it very vulnerable, the system at that point. And therefore, what could have also happened is that people just saw that, panicked, and then that cascaded down into causing more and more panic and created that self-reinforcing mechanism. So while there's speculation, and I believe there might have been a centralized actor behind it, even that's not fully known yet. Whether it was a centralized actor or it was just a breakdown of the system because of panic, doesn't really matter, because if it was a centralized actor, somebody would have come out and exploited that trade, just like what George Soros did with the Bank of England. So it's in a way, it was a flaw in that system, and that just got exploited.
We still have so many questions and there's so much more to discuss, but for today, we'll leave it here. Thank you so much, Benjamin, for joining us.
Thank you very much.
And finally, Temasek is an investment firm owned by the Singapore government that manages a net portfolio worth $273 billion. The sovereign wealth fund has shown significant interest in investing in the blockchain and crypto space, leading a $200 million funding round in crypto firm Amber Group back in February. It was also reportedly buying Bitcoin last year, but in an exclusive interview with Forecast's editor-in-chief Angie Lau in Singapore, Pradyumna Agarwal, managing director for blockchain investment at Temasek, said that's not the case.
So it is one of those misinformations which we have chosen not to comment on, because I don't think it was part of the mainstream media. We don't comment on our direct investing activities. We are very focused on backing the best projects. Mm-hmm. That's really where we are spending a lot of time and activity. Today, Temasek does not own Bitcoin, since you asked me this very pointed question. But that is not a statement on whether we like Bitcoin or whether we want to own Bitcoin or not. I mean, that is just a factual statement of fact for where we are today. Mm-hmm. Where we are very, very focused is looking at which are the emerging protocols, where is the utility.
Yeah.
That is central to all of our activity.
But part of that is tokenization, and a lot of protocols don't have equity. They raise through tokens. So de facto, you are, or your funds, owning crypto in some of these protocols. Is that, that's within your realm?
So Temasek has a flexible mandate. Mm-hmm. We can gain exposure or seek to gain exposure to areas which we think are of interest to us and will deliver appropriate risk-adjusted returns. So yes, it's within our mandate to be able to own tokens, but to be able to own and hold and act on tokens, you need a completely different set of infrastructure.
Yeah, I mean, you don't want to necessarily be in the treasury management space.
One is that. Second is there is a new set of risks that comes with owning this new form factor.
Right.
And therefore, we are getting ready in terms of being able to deal with tokenized assets. But I would say it will need some time to make sure that it meets our operating risk requirements and that we can do it at scale.
And that's the Daily Forecast. And if you want a deeper dive on these stories, the Daily Forecast newsletter can be delivered straight to your inbox. So sign up at forecast.news/newsletter. Thanks for watching. I'm Forecast Maker Shada. Until next time.